If tariffs, tech stocks, and your retirement account all shifted direction today, would your money be safe? Most people would have no idea how to respond. That's why understanding these changes is more than watching the news. It's about knowing exactly how they affect your financial future. Right now, tariffs are moving markets, tech companies are reshaping strategies, and new rules are changing how you can invest for retirement. Each of these shifts comes with hidden winners, hidden losers, and risks that aren't obvious. This is where you protect yourself or set yourself up for bigger gains. Let's start with tariffs. Because they're not just headlines from Washington, they hit your investments directly. Tariffs are taxes placed on imported goods. When the US raises tariffs on certain countries, it means products from those countries cost more to bring in. Recent changes have set rates between 15% and 50%, depending on the country and the product. Brazil faces some of the highest rates at 50%. Switzerland's goods are taxed at 35%. India's exports to the US are hit with 25% tariffs. These numbers aren't small, they ripple across entire industries. Some US industries benefit when tariffs make imported competition more expensive. For example, American car makers who build domestically may see a boost in sales if foreign-made cars become pricier. Certain US steel and aluminum producers also get a short-term lift when cheaper imports are limited. On the other hand, companies that rely heavily on imported parts like electronics makers can take a hit. If they can't find competitive US-based suppliers, their costs rise and profits shrink. The stock market doesn't always react immediately to tariffs. Sometimes, excitement over another story like artificial intelligence breakthroughs pulls investor attention away. In the short term, strong tech earnings can overshadow the potential damage tariffs will cause over the next year. But that delay doesn't mean the impact isn't real. It just means many investors will be caught off guard when the effects show up in earnings reports later. If you're investing in US stocks, you can't ignore tariff exposure. Start by checking whether the companies you own depend on imports from tariffed countries. If they do, look at how easily they can shift production or sourcing. Some firms have already moved operations to countries with lower or no tariffs. Others are doubling down on domestic production, diversifying into sectors less affected by tariffs, such as utilities, healthcare, or domestic service companies, can help reduce your risk. The key is not to guess. Pull up the annual reports or investor presentations for your holdings. Look for supply chain or manufacturing details. If most of their costs come from overseas production, they're more vulnerable. And if you want a broader shield, consider index funds that spread your money across many sectors, so a tariff hit in one area doesn't sink your portfolio. The companies that handle tariffs best are often the ones that prepare before the rules change. They have backup suppliers, flexible manufacturing, and a plan to protect margins. These are the businesses you want to own when trade policies shift. While tariffs test a company's ability to adapt, some corporations are playing a different game, political chess, and your portfolio is the board they're using. Apple is one of the best examples of how corporate strategy and political relationships can mix. Recently, Apple's CEO, Tim Cook, met with the president and presented a small gold-colored gift. The moment made headlines, but the real story wasn't about the trinket, it was about timing. The announcement came the same day new tariffs were revealed on products from India. Yet Apple appeared to secure an exemption from some of those tariffs. Alongside this, Apple pledged to spend $100 billion more on US suppliers and companies over the next 4 years. It sounded like a massive commitment, but big numbers and press releases don't always translate into fast action. Building new facilities, reshaping supply chains, and creating new US production takes years. And in business, promises can change if the political climate shifts. Investors should remember that these deals can be transactional. The company benefits from favorable treatment, and the administration gets a headline that suggests progress. For shareholders, the key question is not whether the handshake happened. The question is whether the announcement will actually improve Apple's operations and earnings. A photo in the news doesn't increase revenue. Efficient factories, successful product launches, and competitive pricing do. When looking at any company in a similar situation, break it down into 3 steps. First, identify if the deal protects them from specific costs or taxes. Second, determine if the promised investments are realistic within the stated timeline. Third, track whether these political wins actually lead to stronger quarterly results. Apple's example shows that public announcements often serve multiple purposes. They influence stock sentiment, build political goodwill, and sometimes secure financial advantages. But without follow-through, the long-term benefit can be minimal. While Apple is navigating this environment skillfully, not every tech giant is in the same position. Some are struggling with competition, leadership issues, and falling behind in critical markets. Intel is one of them. Intel has been losing ground to competitors like Nvidia and AMD. Its share of the chip market has been shrinking for years. Financial performance has suffered from missed execution on major projects. Leadership changes were supposed to turn things around, but the new CEO has already faced political criticism and questions about past ties to China. The company's stock price reflects these struggles. Over the past 5 years, Intel shares have dropped more than 50%. During that same period, the S&P 500 gained almost 90%. This is a massive gap for a company that was once a clear industry leader. Falling behind in a sector as competitive as semiconductors is costly. New chip designs require years of research and billions in investment. Missing a technology cycle can mean losing market share that is nearly impossible to recover. For investors, Intel's situation highlights an important point. A well-known brand name does not guarantee future success. If a company is losing technological leadership, competitors will take its place quickly. Before buying into any struggling tech company, ask 3 questions. Is there a realistic plan to catch up to the leaders? Is the leadership team capable of executing that plan? Does the company have enough financial strength to survive while rebuilding? Sometimes the answer will be yes, and those moments can offer opportunities to buy at a discount. But in many cases, a turnaround story is just a headline without a real recovery behind it. While Intel is fighting to regain relevance, another sector is seeing its own split. Travel companies are showing very different results, and investors are deciding whether to treat them like tech stocks or traditional businesses. Airbnb's latest earnings report looked positive at first glance. Revenue was up 13%, net income rose 16%. Guidance for the summer travel season came in at the high end of expectations, but underneath those numbers, booking growth is slowing. The company warned that third-quarter bookings would not match last year's 8% growth rate. They are also spending $200 million on new services and experiences. That money could help the business grow long-term, but it puts pressure on profit margins now. Airbnb still trades at a higher valuation than many hotel chains. When expectations are high, even small signs of slowing growth can lead to sharp drops in the stock price. Investors are questioning whether Airbnb should be valued like a tech company or like a hotel business. Hotels have been improving their offerings since travel recovered. Loyalty programs, upgraded service, and competitive pricing have helped them regain market share. Airbnb's CEO has acknowledged the loyalty gap and plans to launch a program, but it will take time. For investors, the lesson is clear. Growth companies eventually face the same competitive pressures as traditional businesses. When that happens, the market adjusts its expectations. Before buying into travel-related stocks, look at the industry cycle. If bookings are peaking and costs are rising, short-term growth can be limited. But if demand is steady and a company is expanding into new profitable areas, there may be long-term potential. While travel stocks face questions about growth, another policy change is creating new choices and new risks for retirement accounts. New rules now allow certain alternative investments inside 401k retirement accounts. These include private equity, real estate, and cryptocurrencies. The change could bring new opportunities, but also new risks. Private equity covers a wide range of investments. At the high end, blue-chip buyout funds purchase mature, cash-generating companies and work to improve their operations. Historically, some of these funds have outperformed the stock market over long periods, but access to top-tier funds is limited and fees can be high. On the other end of the spectrum, private equity can include early-stage companies, high-risk ventures, and leveraged strategies that can fail completely. Not all private equity is created equal, so understanding the type you are investing in is critical. Cryptocurrency is an even more volatile addition to a retirement plan. Prices can swing sharply in short periods, and there is no guarantee of long-term value. While some investors see crypto as a hedge against currency devaluation, its unpredictable nature makes it risky for funds meant to provide income decades into the future. If you choose to add alternatives to your 401k, set strict allocation limits, keep them as a small percentage of your total retirement portfolio. Balance them with more stable investments like diversified stock index funds and bonds. Review their performance regularly and be ready to adjust if volatility becomes too high. The opportunity to access new asset classes in a retirement plan can be beneficial, but without discipline, it can also increase the chance of major losses. While new investment options can tempt investors, there is one emotional trap that causes more damage to portfolios than any other. That trap is fear of missing out. Fear of missing out, often called FOMO, pushes investors to buy when prices are already high. It happens when markets rise quickly and the news is full of success stories. The excitement can override careful analysis and lead to emotional decisions. FOMO is dangerous because it shifts focus from long-term strategy to short-term gains. Investors may abandon their plans to chase whatever is moving the fastest. This often results in buying near a peak and selling after prices fall. The best way to avoid FOMO is to set clear rules for investing. Decide in advance how much you will invest, what you will invest in, and under what conditions you will sell. Stick to those rules even when markets are surging. Recognize when hype is driving prices. Artificial intelligence, cryptocurrencies, and high-profile IPOs can create powerful waves of enthusiasm. Some of these trends may have real long-term value, but the best entry points are rarely during peak excitement. A steady approach means buying quality assets at reasonable prices. It means holding them through market cycles and avoiding panic selling during downturns. It also means ignoring the pressure to match someone else's returns in the short term. Discipline and patience are what separate consistent investors from those who burn out chasing the next big thing. By keeping emotions out of your decisions, you give your money the best chance to grow steadily over time. Tariffs, corporate politics, sector shifts, and new investment options all affect how wealth is built and protected. The passive path is about connecting these events to clear actions you can take today. Stay informed, diversify your portfolio, and focus on sustainable strategies that work in both good and bad markets. Like this content, subscribe for more insights, and share your thoughts in the comments on how you're adjusting your own investment approach. Good luck with your investing journey. Feel free to explore other videos on the passive path for more practical insights and actionable steps. See you in the next video.